we did hit that technical barrier, and so far it has held.
Now, once again, everybody, welcome back to the Comstock channel. I'm Marlin Bohling with you, and it's always a pleasure to visit with you about all things ag related, whether it's ag topics, ag news, ag markets, what have you. And today, on Friday, we're going to do a weekly recap of the markets, punctuated by the fact that we had a new November WASDE report that came out from USDA. I have with me Eric Relph of Comstock Investments so that we can talk about what the report did to the markets. And it did have an impact on the markets. I was watching, Eric, as those numbers came out, had a sudden jump in the corn and soybean trade. Soybeans just gapped higher instantly. But then it kind of faded away later in the session. And I wanted to get your take on what happened there. And if you don't mind, let's bring up these report numbers and talk about these with our viewers and see just what was going on. First up, we have the U.S. crop production report.
Yeah.
In these numbers that we're looking at on the screen, what really grabbed your attention first of all?
Soybean yield first.
Okay.
They come out at a 51.7. The trade was looking for a full bushel higher than that at 52.8. Last report from the USDA was a 53.1. I think there was just too much dry conditions. The beans didn't mature properly. They were dry. There was a lot of shatter. We've talked about some of that stuff that we were hearing anecdotal reports of, and here we are. And now we're starting to see some backpedaling a little bit. They actually dropped Iowa 3 bushel. That was a startling number to me. And the reason it's startling is not the 3 itself. It's the fact that whatever they do in November is usually the beginning, not the end of what they're going to do. And so I would expect to see some further reductions as we move through the next several months, honestly.
Okay, now that had one impact here on the trade. Let's also take a look at some U.S. grain ending stocks numbers that came out.
Yeah.
Now, in here, was there much of a surprise or not? It looks like the corn stocks were just as expected.
As expected, and I think that the corn stocks are going to be one that my personal opinion is we're still too high on corn stocks, and that's from the demand side, not from the supply side. I think the yield might be a little overstated, but not to the degree where it's going to make a big difference at the bottom line. I think the demand numbers are understated, and you've got exports, ethanol grind, feed usage, everything really impressive numbers. Now, if we're going to assume that those export numbers are going to start to slide under a Trump presidency, then maybe the USDA isn't off base on the exports, but that'll take some time to develop. The number here today that jumped off the screen was the 470 in beans. I think the trade was expecting 500. That 470 was a bullish surprise, and the trade treated it as such. Unfortunately, we got into some thick resistance and some numbers that I was just talking about in our premium video this morning, and we uncovered a lot of farmer selling, and the rest is history.
Okay, and then we'll come back to that in just a little bit. As far as the wheat number goes on the wheat stocks, didn't seem to be an earth-moving event there, right?
Not anything earth-shattering. I think it was a little bit oppressive that we had a higher than expected number, but not enough to move the needle on the U.S. ending stocks. The global ending stocks versus expectation was enough of a surprise to move the needle, and that did put some pressure on the wheat following the report release.
Okay, and then we had the world ending stocks. Let's take a look at these. On the corn, we had 304.1 million metric tons.
Yeah.
Trade was looking for about 1 million, almost 1.5 million more than that. And here again, the soybean stocks way under expectations by the trade. The wheat seemed to be a little high. So explain this one.
Yeah, that was the one that on the wheat was probably the biggest pressure point. You expected to see something, 750,000 tons lower than last month, and they come in basically in line with last month. And I think that was probably where the biggest pressure came from. Wheat's been moving globally really well. Unfortunately, most of it's been moving out of Russia. So we didn't have a lot of opportunity to sell the U.S. wheat, but the U.S. is not a major world supplier anymore. We were for decades, but that's just not been the case for quite a while now. Corn, not a huge surprise, I guess, to most of us, although this was probably the number that pushed the corn higher immediately following the report. Unfortunately, I think once you digested it a little bit, it wasn't enough to keep us up there. But 2 million metric tons, 4 million metric tons below last month's number and still almost 1.5 million below the trade expectation. It's a big deal. But I think that the global demand and the domestic crush demand is going to be a surprise as we move through the next several months, in hopes that maybe Brazil doesn't have a bang up safrinha crop. So,
But look how much lower the corn ending stocks are than where they were a year ago. I was kind of surprised by that. Where was the corn price a year ago?
yeah, I mean, a year ago we were looking at some pretty decent price levels. I can look and tell you for sure where we were a year ago, but that number was a little surprising. And when you look at where prices were, let's go to the monthly on the continuation chart here.
Wow. That's a monthly?
So in November of 23, we were at 450 to 480 throughout the entire month of November. So anywhere from 20 to 50 cents higher than where we are currently, with a higher global carryout.
All right. So, man, look at how high that corn price had been here a couple of years ago. Is
Yeah,
there
April of 22, over $8.
kind of a shot in the dark to even hope to get anywhere near that anytime soon,
Yeah,
given the kind of carryouts that we have now?
yeah, yeah. I mean, and the problem is when you're at $8, well, we're going to 10, and not enough selling gets done, and the beat goes on. So
How did you think USDA handled the export demand for soybeans?
I think the USDA has a hard time deciphering what the future implications might be on, you know, on either side of the market. You know, they work with the data at hand, and so I think given the data at hand, you know, we're the fourth worst year out of the last 10. We have a lot of room for improvement, but that's going to be negated by Brazil if that crop comes through like they're expecting. So I can't really fault them for what they did, although maybe they're not overly forward looking when it comes to the demand side of things, and that's why I think we're seeing the beginning of these numbers being trimmed and not the end.
Okay, so the way that we closed in the market, that's pretty concerning to me. I mean, here we rocketed higher in soybeans as soon as that report came out, and then we just really fell by the wayside later on in the session.
Mm-hmm.
That seemed to show some weakness. And I just wondered, are there technical points that maybe we achieved as a target and then they backed
Oh,
away from that? What happened there?
yeah, big time. And this was something that I was talking about in our premium video this morning, in fact, for the last 2 mornings. And so looking at the December corn daily chart, we had a high here on October 2nd at 434 and a quarter. I thought if we could get close to that, that was probably going to keep a lid on things. We hit 434 and 3/4. So just right up in that neighborhood, and then we back off a little bit. Now, the corn didn't back off nearly as much as the soybeans, but we did hit that technical barrier, and so far it has held. In the case of the soybeans, I have to look at both November and January, but January 1st, I had put up a bunch of retracements here, and you can see we came a penny shy of that 62% retracement. I was trying to target anything between the 50 and the 62 as points to trigger sales on any held grain that you were looking to get rid of in the short term. And luckily, we got those filled at really nice numbers. And given our local basis and regional basis levels, still selling above $10 cash beans for most everybody that was on board with that. So it worked out okay. But that's what happened. I mean, I had people calling saying, "What happened? What happened?" Well, you know, eventually, when you go up 5 sessions in a row, you've been up 7 of the last 8 sessions. You're going to run into trouble, and people are going to sell, and that happened. And again, we have to keep in mind it's Friday. A lot of the 20-day grace period at the elevators is running out, and so you've got commercials that are prepping for what they're going to have moving over the weekend as well.
Want more? Sign up today for our premium content. You'll receive our reports twice a day, plus every morning an in-depth market analysis with Relph. Every afternoon, you'll receive our daily podcast with Marlin Bohling. The first month is only $1.
Can you zoom back on that chart a little bit to show a little longer time frame period?
Yeah.
Because on my particular January soybean chart, if you go back to those highs way back there, I mean,
Yeah.
I'm talking, it looks like, what would it be? Maybe last spring.
Mhm.
you can actually draw a downtrend line across the highs from like this past month or so, and it exactly touched that too, that
Yeah,
downtrend line.
essentially, it's right. Well, this is on the weekly, so bear with me because I can't I can't get it very broad here.
Okay.
But there's probably what you're talking about.
Yeah,
And
I was looking at a January daily chart, and it was just almost like you
yeah,
say on the retracement level, it was almost within a penny.
yeah, it's right there. I mean, you can this again. This is on the weekly, but this is your downtrend line, and we hit to the T right there. Now,
Yeah.
if this turns out to be a W recovery, which you see often in cattle, you don't often see it in grains. But if that's what this turns out to be, then we will have a breakout. But it's going to take some fundamental trigger, and right now we don't have it because, like I said, we've got this 160 whatever million metric ton crop in Brazil looming over the market, and until that gets a little bit of a different storyline, we've got problems.
Well, talk to me about that. The weather outlook actually looks pretty good, doesn't it, down there?
Absolutely, it does. I would add, though, that there are a few climatologists that are looking for sometime after the middle of this month. So maybe not in the 10-day time frame, but in that 2 to 4 week time frame, that they could have some uncooperative conditions. But the ones that are calling for that are limited, and eventually somebody's going to be wrong, and they could be the ones that are wrong, and it could just be perfect as we move forward. But right now, it's just been phenomenal.
Who pulled the rug out from under the cattle market today?
Unfortunately, it was sheer fundamentally driven. We had a handful of deals done in Kansas at 184 live. That's $6 back of last week. You had a lot of 187 and 188. That's $2 and $3 back of last week. You had a lot of 294 dress trade. That's $3 back of last week. I have to think that by the time they get this all sorted out, we're going to be somewhere in the 225 to 250 behind last week's weighted average. So cash cattle on decline. Box beef has been on decline in a big way over the last 2 weeks. Choice cuts made their high up near 230 or 330. I'm sorry, and now we're back above 300 still, but 308. This is some big ticket items that aren't being very cooperative, and when you have that, you're going to see some weakness. And honestly, I think everybody was holding out to see if the cash price was going to be lower. It was, and they just dumped.
Now, on live cattle, it looks like they just barely poked below the 100-day moving average. Feeders, they went well below it in today's trade. Is
Yeah.
that raising caution flags for you?
Yeah, big time. And there's some other chart formation stuff that could be in play as well that gets a little more intricate, but flip over to the daily here. So yeah, you had some trend line and some retracement level resistance. We did probe it. If you want to call this a trend line, you could and say, okay, we closed below that. We did probe below this retracement level that's on the chart from some time back. But the meaningful stuff is we've had the lowest close that we've had in 6 sessions, and we are closed below trend line support for the first time in the January feeder cattle. Going over to the February live cattle, it looks much worse. And that live cattle chart is what's going to dictate trade, and really the continuation chart, which right now is being made up by December, is going to be a big deal. And you can see how nasty this looks. So looking at February again, you took out trendline resistance a week and a half ago, and you kind of beat around sideways. Now you've got the lowest close in that February live cattle that you've had in a month and a half, something along those lines, 5 weeks anyway. 100-day moving average right below us. That's likely going to give way if we get any lower cash next week. It's really just kind of a nasty look here, but we've got to hold very nearby. We've got about $1.50, or I'm sorry, about 50 cents here in this February contract that we could drop back to the 100-day. If that gives way, then you're talking multi-month lows, and you're below any kind of technical support, because as we went up here, there's nothing to catch it. And so when you come back down, that's a bad thing. And so this is definitely a bad look if we trade more than that 50 to 60 cents lower come Monday or Tuesday.
Well, I know it's not a classic look and it could be a rough looking thing, but is it possible that what you're looking at there is a head and shoulders top?
Absolutely. And that's what I was saying when we get into some other formation stuff that maybe isn't real common, but yeah, it is a little lopsided, but it's definitely got the look of a head and shoulders, and it could break down really hard. And you can see here, we're catching in these lows at the end of the chart here on the right side, we're catching where we had a little bit of a consolidation for a few days on the way up. So again, you break down that level and it's going to be a steep slide.
And for the technicians out there, of course, on a head and shoulders, if that would turn out to be the case, you would draw a neckline on there,
Mhm.
from that first valley to the second valley after that high.
Mhm.
And that usually can project how far down you would go, correct?
Correct. Yeah. And that would be your only real line of defense without going back down to these consolidation highs before the big rally out. So there's a potential here that we could trade this February live cattle down to 180 if that does prove to be the case.
Okay, well, let's talk about maybe something a little bit more positive, and that would be the hog trade. Most of the contracts on the hogs had plus signs, but they were on the deferred contract. So how come?
Yeah, this thing has just been phenomenal for a long time, and I think the hog market is looking at uh, potential demand issues, potential problems with China trade. You go to trade war with China, you're taking your biggest pork consumer in addition to your biggest soybean consumer and throwing fuel on the fire, so to speak. So that potential's out there. I think that's spooking the market. So they're trying to get coverage needs extended out because they may not be buying the physical depending on how things go on the political side. So I think you've got that coming into play with the strength in the deferreds. Today was probably set up to be a little bit of a catastrophic finish to the week, but it was saved by the midday cutout. Bellies were up over $33, and that pushed the cutout $7 higher here to end the week, at least in the midday report. I haven't seen the closing report. It'll come out here in about 10 minutes after we record here. But I wouldn't look for that $7 spike to hold to the close. But still, the cutout swooped in, saved the day, and brought the December contract back from near $2 losses to close dimes lower instead.
Okay, Professor, let's give the ag trade a report card grade here for this week. Man, we had a lot of stuff going on. We had the election that took place. It's finally in the rearview mirror. We had the WASDE report that impacted it. We still have all the geopolitical stuff. We still have all the weather forecasts in South America. Overall, what's your take on how the ag markets performed?
I thought it was split. I think the grains were really good, and they had cause to be good. The river level is getting back to normal. That's taking some of the freight costs down. We should have an improvement in the export program because of FOB prices at the Gulf. So that's an influencing factor. I showed the drought monitor in this morning's video. Massive improvements in some very key regions across the country, and the river level at Memphis is expected to be normal by the first part of next week. So that's something to hang your hat on. The export sales have continued, even though most thought they would be shut off by the end of this week. The weekly numbers were really nice. We did have another additional few daily sales. So that's fundamentally strong. So, like I said, the grains look good. FOMC was one that you left out on your little rattle off list there. The Fed comes out with another 25 basis point rate cut. So a little bit of optimism, and I think that boded well for things overall. Now, the livestock, pork and beef exports were garbage, and we are going to have a rough time moving forward on that front, especially if we start throwing fuel on those fires with regards to trade relations. And some of our biggest consumers have already made the list of headlines. Hopefully, we don't stoke that too much in the coming months.
Do you think China will be motivated to come and at least maybe acquire as many soybeans and or corn before January as possible now?
I think they're going to book the sales, whatever they think they're going to need from us for the next year. They're going to get those sales booked. The problem is they can cancel. And so I don't know. I don't know how that'll all play out. But they usually come to us through February, and so maybe they'll shut it off a little bit early, and I wouldn't be surprised by that at all. And so yeah, I think they are going to be at the table buying for the next 2 months, and then we'll probably see that switch shut off for a little while. But that's not hugely abnormal.
So I wonder how that works. If tariffs are implemented on China, if they have something booked for next year's new crop, 25 corn, 25 soybeans, would the tariffs, if they booked it now, would the tariffs still apply to them, even though they've already maybe bought it?
I think that's all part of the fine print in these tariff policies, and I don't know the answer. I would think that it would be at the time of purchase, but we don't report the exports until they change hands to the foreign entities. Now, China has an advantage because they have foreign entities operating within the U.S. borders. And so all they have to do is literally sign the deed over, and it's now Chinese owned. So if they flush the paperwork quickly, they'll be done with it anyway. And even though it hasn't set sail, it still belongs to China at that point.
Well, there's a lot of stuff to be unraveled here in the next few weeks. So could be exciting times between now and even after inauguration in January. Eric, thanks for explaining everything. I appreciate that. Any last thought on the outside markets? They were wild too. Equity markets were crazy. Crude oil market tanked. We had the dollar value going nuts. Any thoughts on that before I let you go?
Yeah, I mean, I'm trying to not be a picker, but it's hard to do when you've got metals making multi-month lows and the dollar making multi-month highs, and so there's a lot of tradable stuff out there. Unfortunately, it is the big macro market stuff that is heavily influenced by geopolitical and interest rate decisions. But I have to think that with the amount of talk we've heard of late regarding precious metals, that there's got to be some value there. And so that's probably where my attention's focused most, is on that gold and silver.
And the cryptocurrencies had a big week too.
I don't dabble in those, but it was some really impressive trade and new all-time highs again, along with the stock market.
Absolutely. Well, we're putting a lot of black powder in the market, that's for sure, whichever way it wants to go. Eric, have a good weekend. Thank you, sir. I appreciate the time. Eric Relph with us from Comstock Investments. That'll do it for this episode, and we hope you have a great weekend out there. For producer Brianne Hendrickson, I'm Marlin Bohling. We'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.